Rick Rule of Sprott U.S. joins me today to talk about the opportunities and risks in the gold mining and gold bullion space. Rick, welcome back. Thanks for being with me today. Now, you were telling me offline that the junior mining sector is getting ahead of itself. Care to elaborate?
Yeah, I think that's right. You know, it went from being a year and a half ago to being substantially oversold. And I suspect by now, and I'm not talking about each individual company within the space, but the space itself, I think is really substantially overbought. The truth is that scores of companies have been willing and able to do very, very, very large financings. And the quantum of those financings, both in terms of the pre-money valuations that they went off on, but simply also the amount of money that they consumed, that is to say, took out of the market, I think is going to dampen the sector for a while. A lot of the financings that have taken place in the last 4 or 5 months are going to be coming off restriction. So in addition to the fact that there are new financings coming in place that are going to mop up some money, resales are also going to mop up some money. You'll recall in prior interviews that you and I had that I urged caution in the sector overall, given my supposition that out of 1,500 junior listings worldwide, probably only 200 or 300 are viable. Many of those viable ones have become a little less viable simply as a consequence of their market capitalization. And amazingly, many of the non-viable ones have gotten financed. So this is the time to exhibit caution. I'm not saying to exit the sector. What I'm saying is, in terms of the whole sector, the easy money has been made. That doesn't mean that the big money isn't in front of us in individual issues. It just means that it's time to exhibit substantially more caution than we've had to exhibit over the last 12 months.
You and I have spoken about this several times, and I think this is the first time in many months that I've heard you exhibit this message of caution so strongly, should I say. Something must have triggered you. What data were you looking at recently?
We've reviewed an awful lot of individual financings here at Sprott. And there were companies that we suggested had risk-adjusted net present values at current commodity prices of sort of $15 or $20 million. They commanded pre-money valuations of $100 million and went out to raise, say, $20 million and came back with $50 million, which means that the post-money valuations, and I'm being apocryphal now, the post-money valuations were 150, 160, 170 million dollars in deposits that we thought had risk-adjusted net present values of 15 or 20 million dollars. The second thing is a more macro call, to be honest with you. It just has to do with the fact that the market has gone from strongly oversold to less strongly oversold, maybe even overbought. I complain all the time about the printing of worthless certificates done by central banks in Canada and the United States. But you know, the private sector is always more efficient than the public sector, even when it has to do with counterfeiting phony share certificates. And we're going to have to work through all of these strange share certificates the way we have to work through these overabundant Canadian and US dollars.
I spoke to a mining analyst before you, and he said that investment demand in the gold mining sector has usually been, not always, but usually been a leading indicator for where gold prices are headed. Do you agree with this sentiment?
You know, I've been pondering that question myself for 45 years. And I have to say, after 45 years of thinking about it, I'm still not sure. Investors en masse are often as wrong as they are right. What I have learned in my career is that lack of demand in the equity markets is what you're looking for. If you have no competition, stocks are cheap. And if stocks in the sector are cheap and you buy the best stocks and you're prepared to own them for 2 or 3 years, that is, if you have the courage of your convictions, if you're willing to hold stock over a long weekend, you'll almost always make money. Frankly, I'm personally much less comfortable being in a sector that's popular than I am being in a sector that's unpopular.
Well, I know that long-term you are still bullish on the metal overall. And I'm curious as to why you think the overbought situation is happening now. Do you think the cycle is the cycle of bullishness is ending too soon?
I don't. I think that the sector is near-term overbought. So really, there's three ways to answer that question. As we've discussed before, the wind is in precious metals sales, quantitative easing, debt and deficits, artificially low interest rates. All these are good for gold, and none of them are likely to change. So the gold price, in my view, goes higher, perhaps sharply higher. In prior gold bull markets in my career, the equities bull markets followed very predictable patterns. The biggest and best companies, the highest margin companies, the most liquid companies moved first. So the Barricks, the Francos, the Wheatons, the Agnicos moved first. Then the second tier, what I call the best of the rest, would move. After that, the single asset companies that were perceived as being riskier because they only had one source of income would move, right? Then the advanced development companies would move. Then the advanced exploration companies would move. Then the juniors would move. What happened this time was that leadership went right straight from the best of the best to the juniors. I've never seen this happen before. So the flow of funds didn't cascade down the quality trail the way it traditionally has, but rather leadership went right straight to all the rest. And I think that they're ahead of themselves. I understand the reason for this. There were companies that were completely non-viable at $1,200 gold that have some viability at $1,900 gold. And because discoveries are extremely scarce, high-quality discovery stories get sold at eye-popping prices. The sad truth is that of the 1,500 listed companies out there, the vast majority have no viable rock in the ground and won't make a discovery. So looking at the macro disguises the extraordinary risk apparent in sort of 1,200 of the $1,500 names in the junior sector.
Right. Now, so Rick, given your sentiment, would you be rotating capital out of the juniors into the seniors then right now?
I have been doing exactly that. I've been rotating capital out of some of the juniors, taking profits where I thought that profits had been given to me too easily, and moving up the quality trail. In addition, with new money, and there's lots of new money coming in the sector, lots of new money in the sector. When somebody comes to me to establish a gold portfolio, somebody who is new to the sector from another industry, I'm putting that money in the best of the best. I'm hoping that they participate in the beta without trying to generate alpha by owning smaller names. If we take the gold price or the silver price as high as I think it might go in the 2 or 3 year time frame, the amount of money that you'll make in the best of the best stocks, I think, could be eye-popping. And I'm even willing for new money to underperform the index by owning the best 5 or 6 companies in the index. In other words, if I can de-risk the index, I'm actually willing to underperform it because I think the index will perform so well for new money.
I think everyone wants to know, how does the great Rick Rule pick the best of the best? Can you just, in 60 seconds, run down your process? You don't have to get to the nuts and bolts, but just what's your philosophy here?
It depends on what sector we're talking about. If we're talking about my comment, the best of the best, I like operating margin. I like very, very, very high margin companies. I like tier 1 deposits, more than 5 million ounces, producing more than 400,000 ounces a year. I'm less fussy about jurisdiction than many of my peers. I'm reasonably comfortable in Russia. I've made a lot of money in Congo. I will never say I'm comfortable, but I really care about people. So if you give me a Pierre Lassonde, if you give me a Randy Smallwood, if you give me a Mark Bristow, Sean Boyd, I become a lot more comfortable. What you find with these tier 1 deposits, by the way, and the best of the best, these tier 1 deposits, well, all deposits give you surprises, but tier 1 deposits always give you good surprises. Tier 3 deposits usually give you bad surprises. And at 67, in my declining years, I would prefer good surprises. The other thing is that all of these companies that are classified as the best of the best have a lot of mineralized material that didn't count as reserves at $1,200 gold, that is suddenly economic with $1,900 gold. None of this stuff has made it into the balance sheet and won't make it into the income statement for 2 years. But given the extraordinary sunk costs with regards to infrastructure, this mineralized material that was marginal before is highly economic and doesn't yet fit into most analysts' discussion of these companies. The further thing about the best of the best is that, with the possible exception of Pierre Lassonde, most of the managers don't believe in their product. Most of these guys' budgets are based on $1,200 gold or $1,300 gold. We're in a $1,750 to $1,900 environment, and I would wager over the next 2 years going higher. So my suspicion is that there's more torque left in the best of the best than is widely suspected by other analysts.
All right, let's move out of the mining sector now and talk about money in general. I know you've had a lot to say, you and I, about Fed money printing, but here's something you don't hear every day. The ECB, one of the largest central banks in the world, is now contemplating a digital euro. This is after the Chinese central bank have issued experiments of the digital yuan. Can you believe it?
I love it. I mean, to be honest with you, I'm a consumer of currencies. And so to the extent that there are more people competing to serve me better, I think it's wonderful. I would hate to see a world where the only opportunity to save and spend would be in US dollars or yuan or euros or anything else. I'm also fascinated with this digital technology. Sprott, by the way, in conjunction with Kitco in some cases, has been a pioneer in investing in digital strategies, distributed ledger strategies associated with gold, which I think is just one of the applications with digital currencies. I think from the government's point of view, the fact that they don't have to spend money printing a promise is efficient. They can conjure up these fake currencies with a keystroke now, which from their point of view is a wonderful thing. In terms of its investment implications with regards to gold, I think it might matter a little bit on the edges. I think that the Robinhood crowd might be currently more enamored of the digital and technological narrative than they are the older gold narrative. But I am noticing in our own business the influx of very young investors into precious metals, coming to understand the narrative that there should be a medium of exchange that's simultaneously a store of value, rather than a medium of exchange that's a promise to pay from a government, is something that has value. And so I don't think ultimately that crypto and precious metals compete at all in the middle of the space for a medium of exchange. I think rather they cooperate. They're part of a basket of transactional technologies. The advantage that precious metals have over other transactional technologies is simply that they aren't a promise to pay. They constitute payment itself. Gold and silver are very useful in that regard. That isn't to say that distributed ledger or blockchain technologies aren't useful as mediums of exchange, because they formalize the trust in an exchange transaction, which is very, very, very valuable. But I don't see them as replacements for precious metals. And particularly, I don't see them as replacements for precious metals in emerging and frontier market societies where the level of social trust is extraordinarily low. Relying on a promise to pay, even a fiat promise to pay, particularly outside one's host jurisdiction, is a leap of faith that billions of people aren't willing to make.
Here's a 21st century argument for why I think digital currencies might be a threat. Gold has been a form of money for 5,000 years and perhaps even longer. But the first 5,000 years of human history weren't dominated by the internet and the digital age. And now we're living in a time where people are paying for their groceries with their phone. So why would I go through, as an investor, why would I go through the trouble of investing in a company that's going to literally dig things out of the ground, rather than investing in a company that can produce money out of thin air?
Well, there is no company that can produce money out of thin air. There are countries, that is to say China or the European Union or the United States, that can conjure as opposed to produce promises out of thin air. The beauty that precious metals have as mediums of exchange is that they are not promises to pay. They are payment itself. Every other medium of exchange is simultaneously one person's asset and somebody else's liability. My friend Doug Casey describes fiat currencies as IOU nothings, and the common currencies like the euro as who owes you nothing. Now, in an era like today where there's a fair amount of social faith, that's fine. In circumstances where that social faith gets called into question, it's much less fine.
Finally, Rick, do you have any thoughts on how the elections will impact gold and investments?
I think in the very, very, very near term, gold moves well on fear. And I suspect a Biden presidency in the very near term might cause the country club Republicans some trepidation, given his pledge to redistribute wealth and put in place higher corporate taxes. The truth is that neither the Democrats nor the Republicans are committed to policies that would help the country or be bad for gold. They're both committed to quantitative easing, which is counterfeiting. They're both committed to excess spending. They're both committed to debt and deficits. They're both committed to negative interest rates. So my suspicion is that whether the Democrats or the Republicans form the next administration, that the policies that they have put in place will, unfortunately for the people, be extraordinarily good for precious metals. I say this in effect with a heavy heart. I certainly will, in this circumstance, be profiting on the misery of mankind. And in fact, profiting on a transfer of wealth to my generation in terms of entitlement from your generation. The generation that's going to have to pay the bill. But somebody has to profit on it, so it may as well be you and me. May I have one final word?
Of course.
I love to visit with the Kitco audience, and I would love to offer them an inducement to visit with me, which is to say any of your audience that goes to SprottUSA.com/rankings, I personally will rank your natural resource equity portfolio 1 through 10, 1 being best, 10 being worst, and I'll comment on those issues where I think that my comments might have value. I've enjoyed my discussion with you and your audience, and I look forward to many more.
You've brought this up several times. Would you like to share one of the more bizarre or out there kind of submissions that you've received in the last few years of you doing this?
Well, certainly I've reviewed some portfolios that were truly spectacular portfolios from people who didn't know very much about mining, but knew a reasonable bit about balance sheets and income statements. I have also reviewed some portfolios that are really truly farcical. Portfolios that were $500,000 portfolios that had, from my point of view, no merit whatsoever. The overriding comment I have is that most people, your viewers and my clients, own too many speculative stocks. I'm not trying to say that they're too speculative. What I'm trying to say is that they own more stocks than they could possibly follow. I have learned in my life that most reasonably astute speculators should own the number of companies which corresponds with the number of hours per month that they plan to spend studying the companies in their portfolio. So if you're willing to allocate 10 hours a month, you can own 10 stocks. But too often I've reviewed portfolios that were mini mutual funds, 100 stocks, 110 stocks. And when I visited with the owners of those accounts, they didn't remember why they had bought.
Well, I think the rationale here, correct me if I'm wrong, for any investors that, okay, if I don't have time, let's say I don't have 10 hours a week to do my own due diligence, I'm just going to go buy a basket of whatever I can find, because diversifying would negate the responsibility of cherry picking individual securities. Isn't that right?
I think that is the rationale. Diversifying across a bunch of worthless names is a highly, highly risky strategy. And frankly, not having the courage of your convictions means that in a highly volatile business, like the gold equities business, where the equity index can decline 15% with the same ease that you exhale, means that it's too easy to get shaken out of your portfolio if you don't have faith in it. There are other reasons to study, because you become psychologically prepared to handle the volatility that accompanies the sector.
Rick Rule, thanks very much again for your thoughts. Look forward to speaking with you again.
Thank you so much for the opportunity. I look forward to speaking with you.
And thank you for watching Kitco News. Stay tuned. We'll have much more.